Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. We're going to talk to Sean McLaughlin from All-Star Charts here in a few moments. We'll talk about this choppy market. I'm a little disheveled because I'm looking at the market literally fluctuating as we're getting ready to go live here. Today sort of is it capsules everything we've seen. We have lower prices, we have higher prices, we have quick reaction to sudden news flow, and we end up not going anywhere. It's a sideways day by any definition. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller, here at StockCharts.com, here in a very sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market environment, looking at a lot of charts, using the technical toolkit to better quantify investor behavior, looking at the messages of price, trend, and momentum, trying to better understand what is happening here. The quote that I've been throwing around a lot recently is a Jesse Livermore quote. There's a time to go long, a time to go short, and a time to go fishing. And it feels like we're sort of in that potentially that third category. You have times in the market where there's a clear uptrend. There's sort of a consistent upward move. Things are in a nice, slow and steady climb. Potentially, when we talk about energy stocks a little later with Sean McLaughlin, we'll talk about that particular sector and where the opportunities might be. Other times it's such an obvious short opportunity or an obvious opportunity to go full risk off. And then there are these choppy sideways moves where you get a little of everything. What's interesting to me, though, is when I was screening for new highs and new lows, I am not struggling to find stocks making new highs. They're all over the place. We'll highlight some of them in the show today. I'm also not struggling to find stocks that are breaking down, and that nets out to major averages being sort of flat in the middle, which is what we've been seeing. A lot of charts that we need to break down on the show today. Excited to talk to Sean McLaughlin here from All-Star Charts in a little while. Coming up the rest of this week on the show. Tomorrow, I will be off actually Thursday and Friday this week. So tomorrow, Julius DeKempener from RRG Research has agreed to guest host the show. He is the master of all things rotational. So a perfect time to have him come on and talk about some of these leadership themes that we've been breaking down. On Friday, I actually just recorded a special episode called Trend Following 101. We'll talk about, I think, the 3 goals you should have as a trend follower. We'll talk about some example charts that break that down and what that toolkit is telling us about the current market environment. We're going to take Monday off for the market holiday, and then we'll be back all the rest of next week. Also, our latest episode of The Pitch is coming up next week on February 25th. Grayson Rose from here at StockCharts is going to moderate a conversation with 3 guest experts, each pitching 5 ideas, and then they'll discuss those as a group. It's a lot of fun. Go to stockcharts.com/thepitch for more info on that upcoming special. We need to get to our market recap, brought to you today by Chaikin Analytics. If you go to StockCharts ACP, there's a little plug icon in the bottom right corner. That is our plugin platform. You'll see the Chaikin plugin, which features the Chaikin Power Gauge. So check it out. Let's go to our market recap. We'll talk right now about the S&P 500. And as I mentioned in the introduction, sort of an example of what this entire stretch, I think, has been in. The month of February sort of, boiled down into one chart. You have a lower move out of the open. So much of the day felt like a continued weakness of growth, continued strength in some of the value-oriented sectors like energy and materials, some of the stocks we've been highlighting certainly on the show in recent weeks. But then you have the Fed minutes from the January meeting come off. The market rallied very, very quickly, but then sort of came off going into the close. So at the end of the day, directionally, the S&P was essentially flat. It was up 0.1% for yesterday. The NASDAQ composite down 0.1%. So a lot of noise, a lot of volatility. But in the end, directionally, we went that painful third direction. Remember, markets can go higher, they can go lower, they can go sideways, and that certainly seems to be what we're seeing here. The S&P and most benchmarks in a big range, depending on how you would want to define that. Mid caps and small caps both up, but not by much, about 0.25% each. And the VIX is back below 25, ending the day around 24.40. Bond markets also sort of choppy sideways. Interest rates really didn't move a ton. They opened up a little lower, and the 10-year yield got down to 201, but ended the day right around where we finished the day yesterday at the end of the day on Tuesday. So about 205 on the 10-year. The dollar index down, but not too much. So again, today was sort of noisy, but not as much direction. Where you did see some follow through was in the commodity market. So energy stocks, the best out of the 11 S&P sectors. Commodities, you actually see gold and silver up, both up over 1%. And that renewed strength in gold is an interesting one. You know, the chart of gold has been very much sort of flat to down for quite some time. All of a sudden, you see gold really rotating back to the upside. And we've talked about some of those mining names. We talked about BHP and Rio Tinto recently on my new screen earlier today for market misbehavior premium members. I'm finding things like Newmont Mining and gold, GOLD, and other gold stocks actually rotating and having sort of that rounded bottoming pattern, showing a pattern of accumulation. If you're not there yet, if you haven't looked at some of those materials names, I found a lot of breakouts in the materials sector. Cryptocurrencies sort of mixed to down, with Bitcoin and Ether both down just under 1% from yesterday's close, or the end of the trading session. Those obviously trade 24 hours. Looking at a chart of the S&P 500, so we continue to, I think, can reinforce the importance of the 200-day moving average. We are clinging to the 200-day. 3 of the last 4 trading sessions have overlapped the 200-day moving average. This sort of shows you where we're at. You know, on Thursday into Friday of last week, we broke below the lower Fibonacci level, and what we had talked about was sort of what I described as a range within the range. You have the high from January, the low from sort of mid-late January, and from there you had a couple Fibonacci levels, 38.2% around 44.50. That's right around the 200-day moving average. On the upside, we had 45.90 is the 61.8% retracement level. We touched that a number of times here in the last couple of weeks. We're back within that range. So even though we broke down there on Friday into Monday, when we continued lower to 4,400 on a closing basis, we've now bounced back into that range. So holding the 200-day moving average, if you're bullish on this market, that is sort of an absolute must-have. You need to be remaining above the 200-day. Otherwise, this is further deterioration. So, you know, yesterday and today sort of a bounce higher, but no real follow-through yet. I think this is still a sideways, choppy market. It's interesting that the RSI is literally almost right at 50, which is the definition of a lack of momentum, right? If you see that hitting that middle boundary, that's when the market's sort of in equilibrium. Buyers and sellers in general are in agreement of where this market is going to be. What's so interesting, though, is if you think of that as the backdrop, but then look at individual stocks and sectors. As I mentioned earlier, I'm not struggling to find stocks that are in consistent uptrends, and even stocks that are breaking to new highs. I'm also not struggling to find stocks that are gapping lower on earnings, that are showing a lot of internal weakness. So it's sort of like the market is netting out to a flat market, even though there is a lot of movement sort of around that, right? If you have one huge upswing and one huge downswing, you average out to a zero, but you know, there are a lot of movements there. And I hesitate to call it a stock picker's market, because I think that's sort of an overplayed description, but I'll do it. It's a stock picker's market. This is a time when you can differentiate. And energy, materials, the cyclical sectors are certainly where you've seen a lot of strength. We've talked about energy many times, and we're going to talk with Sean McLaughlin here in a little bit about the energy sector and where we might see some strength. But a little later in today's show, we're going to do a segment called The Bottom Line, where we focus on earnings. We've had a lot of companies reporting earnings this week, and some interesting ones coming up today. Things like NVIDIA, Cisco, Applied Materials. So we have some semiconductor names to look at, and others in like Airbnb and elsewhere. But I do want to mention, you know, charts like Alcoa exist, right? This is a materials name. It's an aluminum stock, and it's just been in a consistent uptrend. So it's interesting to me to see charts like this, that if you didn't know the market was super volatile, if you didn't know that there was a lot of uncertainty, if you didn't know the averages had come off quite a bit and now we're in a choppy sideways trend, the chart of Alcoa tells you things are sort of long and strong, like, you know, sort of doing well. You have Alcoa trading upwards or continuing to push higher, trading above an upward sloping 50 and 200-day moving average. The relative strength has been consistently strong going back, you know, for 12, 16 months. So overall, there are charts like this that have been working, and it's not just in materials. Although I'm certainly finding a lot of names there when I'm screening for stocks that are improving. It's worth noting Alcoa, by the way, out of the entire large cap universe that we track, it is now the top ranked scooter ranked stocks. That's the StockCharts technical ranking, where we take a big large cap universe, we rank them in terms of their trend characteristics. It's a proprietary method, but we share the formula with you on our website. Go to the chart school section and look for SCTR, the scooter ranking. You'll see what it is. It has a long-term, medium-term, short-term components, all weighted a little more to the long-term than the short-term. And it makes sense if you take a step back and look at the chart of Alcoa, why a stock like this scores pretty well. If you look, by the way, at the dashboard on StockCharts and you look at the other tickers, you're going to notice one sector probably represented way more than others, and it's a lot of energy. DVN, MRO, Halliburton, Apache, CNQ, all sort of popping up on the list. FANG, Diamondback, all up there as well. So it's a lot of sort of raw materials, energy sorts of names that are bubbling up to the top there. So the XLE was the number one sector today, up 0.8%. Materials, number two, up 0.7%. Industrials, number three, up about 0.5%. So what was not working today? It's the growthy stuff in general, right? So you have communication services down 0.7%. That was the only sector that really struggled today. Technology essentially flat for the day, along with financials, healthcare, and others, and the rest sort of in the middle of the list. In terms of other things that are gapping down and such, I will highlight VIAC. This is Viacom CBS, and it's interesting. I always tell people on a chart like this, the gap may have surprised you, right? The severity of the move lower, gapping down about 18%. Maybe that was a shocker. Hopefully the direction of the move has not been much of a surprise, because we've been highlighting names like these that are in established downtrends, right? I often tell people prices don't tend to move lower for no reason, right? When the price goes down, it tends to go down for a reason. On the other side, prices tend to go higher for a reason. Charts like VIAC, charts like Discovery and others that have been struggling, they've been struggling for a while. You wait to see when there are signs of accumulation, a rotation from distribution to accumulation, which is why something like Discovery may be setting up a little better here, because now you've established a higher low. You can maybe start to work through that going forward. We need to take a quick break. We'll be back with today's guest, Sean McLaughlin. We'll see you in a minute. Using the power of stock charts, using technical analysis tools and techniques to better understand the market environment. A couple quick announcements before we get to today's guest, Sean McLaughlin. First off, we welcome your questions. We're going to do another mailbag segment probably Tuesday of next week, and we'd love to feature one of your questions on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. It is totally free. Great guest experts like Sean McLaughlin, Jay Soloff, we spoke to yesterday from Investors Alley. Our special events like The Pitch, Larry Williams' Market Outlook, and his special they just released today, all on demand. From our website, StockChartsTV.com, or from your mobile device, just search for StockCharts TV on demand. I want to welcome on today's guest, Sean McLaughlin, joining us on the show again. Sean is the Chief Options Strategist at All Star Charts, coming to us from Boulder, Colorado. Sean, good to see you. Welcome back to the show.
Always a pleasure, Mr. Keller. Thanks for having me on.
Absolutely. We're starting with the chart of the S&P 500 here. I sort of described it in the market recap as a sort of choppy, sideways, uncertain period. And before the show, you're sort of giving me a similar take. How are you making sense of this current environment from your side?
Well, I mean, it's quite a paradox that you laid out earlier about how there's no shortage of stocks making highs, and there's also no shortage of stocks making lows. But when you look at the indexes, when you look at SPX like this, or you look at the QQQ, or even if you look at the IWM, the Russell 2000, they're telling a different story. They're telling a wide range, sideways, choppy slop. And for the majority of swing traders of any kind of time frame, whether they're in and out in a couple of days or in and out within a few weeks, the traders that I talk to every day, the traders that we talk to at our shop, people are struggling. They're getting chopped up. People are afraid to get too aggressive in any one direction, and we feel it. It's if you're not taking quick profits in this market, the market wants to take it back real fast.
Choppy slop is such a great way to describe this current market environment. I think that's totally fair. So, what for you, and I want to talk about energy here in a minute. So it's obviously a really interesting story to break down. But when you're looking at a chart of the S&P or the Qs, what would you need to see to tell you that the sort of choppy slop phase is over? Is there a particular level or particular breakout or breakdown that would convince you, okay, now we know what's coming next?
Well, if we're looking at the SPX, I think obviously getting it above 4,600 is a major hurdle. And I'm not saying anything that people can't tell just by looking at that chart. I mean, we got to get above there before I start getting confident that we can start making aggressive bets on the bullish side. Meanwhile, 4,300, if we can get below 4,300, even 4,250, I mean, that opens up a whole Pandora's box of a lot of unknowns. Like, we don't know what happens down there. And I got to be honest, I thought maybe with today's news out of the Fed meeting notes or minutes, whatever that is, I thought maybe we'd see some downside action. Maybe we'd start seeing some more conviction on the downside. But hey, the market likes to confuse the most people most of the time. And I think it's achieved its goal today.
It certainly appears to be happening. Now, one area of the market, obviously, that's been showing strength, I mean, year to date, by far the strongest sector is energy, right? You have energy names that have been consistently strong. I mentioned earlier, out of our scooter rankings, our trend following rankings, most of the top 10 are in this energy sector. How do you see this? We're looking at the OIH here. What do you think about this current move at this point?
So the oil sector, as well as the energy sector, I mean, this is a sector where we've been seeing strength for a while now. We've had our clients positioned not only in the oil sector's ETF, but in Halliburton, names like Schlumberger. We have options positions in Chevron, CVX, as well as Cheniere. I hope I'm saying that right. Cheniere Energy, that's ticker LNG. We've been positioned already and it has been working. And there are a bunch of other names in this space that are working. But here's the challenge that we've run into when we're trying to come up with new ideas is, as you mentioned before, there's no shortage of stocks right now making all-time highs, as well as making 52-week lows. But a lot of those moves feel very extended right now. And with the indices as a whole just kind of chopping around in the middle, it's very hard to get aggressive on a stock that's already had a great run. And we've seen so many especially in this oil space and the energy space that have already had great runs in the last 3-4 months. So we're tentative to get aggressive here. We're maintaining the positions that we have. We are bullish and we have no reason to not continue holding those positions. But do we want to get aggressive here? I don't know. I mean, since we have Chevron up right here, I mean, this is probably the most aggressive trade we have on. And it's not aggressive because we're taking a lot of risk, but it's aggressive because we're doing a very lengthy time frame. As the options strategist at All Star Options, I'm putting out options trades and options ideas, and they generally tend to be in the 4 to 6 month range. That's kind of the length of trades that we're looking for. This one, we bought leaps, David. I haven't bought leaps in forever. Wow. We went out 2 years to January 2024. We bought the 150 strike calls in CVX. And so we're in it for the long haul, hopefully, fingers crossed. Of course, we are risk management levels in place that we'll honor. But that's the only way right now I feel comfortable getting aggressive in these names that have already had great runs.
It's such an interesting way to think about it. I don't know if I've heard you mention leaps before, Sean. This is a new Sean McLaughlin we're talking to, but I get right, like a long-term, right, something with an expiration out quite a bit, right? So it's more of a longer-term outlook on some of these names. Listen, Sean, this is awesome to talk to you. It's good to see you. I wish we could spend more time, but we have to move on. Stay safe, and we'll talk to you again soon.
All right, David. Thanks for having me on, as always.
That's Sean McLaughlin. Sean's the chief options strategist at All Star Charts. It's interesting, he mentioned about looking at some of these energy stocks, and I love, if you caught that, he sort of went through that quickly at the end, but he talked about how these energy stocks have had good runs, but they've had the run, right? They're pretty extended. On the other hand, some of the growthy names that have been struggling for a little while. So you sort of have this potential mean reversion. I think that's the risk with a lot of these trades, and you heard what Sean was saying, right? The idea is, stick with it if it's working. And I think there's a lot of wisdom in that one comment that he made. I think if you take one thing away, stick with what's working. And when I'm asked about things like energy and others, it's, the chart will tell you when it's not working anymore. It's not necessarily telling us just yet. Great take there from Sean McLaughlin from All Star Charts. Our next segment is the bottom line. What we like to do is look at earnings season. We're sort of wrapping down the meat of earnings season, but there are a bunch of companies actually reporting this week. And semiconductors are actually coming up quite a bit. And this is an area of the market that certainly has been a focus for many investors for quite some time. We have a couple of these names to highlight here, and I'm not looking at the aftermarket trading on some of these only because it's a pretty noisy time. We'll see how things play out. So I'll take more of the longer term view and then think about how that relates to what we're getting from the reports today. So a couple of reporting after the close today. We have NVIDIA, Cisco, Applied Materials, which we'll look at here very briefly. So NVIDIA is an interesting one. This could go one of two ways, which is why I think it's at such a pivotal point. This is what we could call a bear flag pattern. And I put a note out on social media, I think it was today or yesterday, on the ARK Innovation Fund, ARKK, with a potential bear flag pattern. What that means is when you have a big run lower, then you have a move back to the upside. And you have a parallel channel of higher highs and higher lows, sort of against the longer term trend. The problem with that pattern is if it breaks the lower trend line, take a trend line connecting those lows, if we break that, that indicates a much further downside from there. It's called a bear flag, and usually it happens about halfway through the move, which means you take the move into the pattern and subtract that from the breakdown, which puts us, really basic back of the envelope, down around 140, 150 as I'm eyeballing that. But that is a big if. The if is you break down through that pattern. You have to validate that bear flag by getting breaking down the pattern, resolving it to the downside. Otherwise, you're putting in a pattern of higher lows, and it's actually showing short-term accumulation. So a really key decision point, I think, right now with NVIDIA. The chart of Applied Materials a little bit different. We have that same sort of bear flag pattern. The issue that compounds Applied Materials is you're also bouncing off of long-term support. Around 125 has been a key support level for AMAT, right? You have here in July of last year, August, October, that was off the 200-day as well. We've now broken below the 200-day moving average and really trading right around it, just like the S&P itself is doing. This is one or two down days or even a gap lower away from looking really negative. That's what concerns me about some of the semiconductor charts. You've had a nice bounce off of the lows, which is encouraging. But if you break down, all of a sudden this turns this into a bear flag pattern that measures down to around 100, which would take us pretty far down and retracing much of the gains from late 2020 into early 2021, but clear support around 125, and that's a level I would be paying attention to, regardless of what happens with earnings today. Cisco is a little more challenging only because it's sold off so dramatically, and if you would go any lower than this, really, I think you validate more of a topping pattern, a basing pattern of a consistent support level. We've tried to go off of that level many times and have failed. We get much lower than current levels, to be honest with you, and this is validating more of a longer term breakdown, which measures a lot further. So those are three key names to pay attention to in terms of what happens, after this earnings release today. Charts like Shopify, when people ask me, well, what told you, what could have told you to, to anticipate this sort of gap lower? I would argue that's not really how this works. It's really hard to predict where a gap is going to occur, even around earnings, as much as, you look at analysts' ability to actually predict what a company is going to earn. It is not an easy game. And I laugh when people, ask about charting and how accurate it is. I would say trying to predict what a company is going to earn is even more challenging than the charts, in my opinion. But having looked at it, could I have predicted that the stock was going to gap down 16% today? Probably not. Would I have told you that the path of least resistance is lower and to be prepared for something like this? Absolutely. And I think the reality is on a chart like Shopify, just like a chart of Meta platforms or Netflix or any of these stocks that had been leaders. I mean, this is a couple months after a break to new all-time highs. Shopify in mid-November can do no wrong. I mean, it's to the moon type of breakout, but it immediately failed, right? Immediately came back down. You didn't really have that follow through to the downside. Then you're testing the 200-day and it's failing to hold the moving averages. That's a chart and distribution phase. You break of clear support, break of moving averages, and now we're in a downtrend. Most recently, you have what's called I call that a pennant pattern, which is a big run lower. It's kind of like a bear flag, but a consolidation right around the 850 to 900 level. That's now resolved to the downside. This is a chart in distribution mode. This is a chart that measures a lot lower than current levels. So while the 16% drop today may surprise you, hopefully the direction of the move should not, because the chart has been giving you plenty of evidence that buyers are not there. It's in a distribution phase. It's in a downtrend. And I wait for the weight of the evidence to turn more positive, wait for buyers to come in. And we're not certainly seeing that yet. Finally, I'll mention Hilton. You have a couple hotels all around here. Marriott yesterday, you had Hilton today. This is the chart of Marriott, and these hotel names, just like gambling stocks, just like airlines, all starting to break out of these basing patterns. Out of all of those that I just mentioned, probably Marriott's one of the better ones, hitting consistent resistance around 170 over the last couple weeks, breaking out, retesting it, and then resolving to the upside. Breakouts like that, I think the benefit of the doubt should be given to charts in uptrends making new price and relative highs. We need to wrap today's show and go to the 3 in 3 charts in 3 minutes. Here we go. Chart number one, we didn't talk a lot about EM, and we haven't in quite some time. And I think the main reason because emerging markets in general have been underperforming. This is looking at two ETFs, the EEM, which is a global emerging markets ETF, and then EFA, which is EFA, which is basically developed non-US, Europe, Asia, essentially. And what you can see is the price has certainly gone lower. This ratio made a new low going into the first week in January. From there, it's basically been in a pretty decent uptrend. So if you've been ignoring EM, like I certainly am guilty of doing, as an allocation, thinking about it opportunistically, this ratio going higher should tell you to start to pay a little bit more attention to it. So in general, emerging markets tend to be a little more skewed toward a couple sectors: energy, materials, financial. Certainly a lot of our emerging markets, there's a big financial component to them. Those are three sectors that are tending to set up pretty nicely here. And that's why I would argue, among other things, that EM is starting to look a little more attractive. So maybe a good opportunity to pay attention there. Great take today from Sean McLaughlin. It's always great to have him on the show. And he was talking about some of the stronger charts that were out there. We talked about some of the energy names like Chevron, and Alcoa is one I highlighted in our market recap. This is a chart making new price highs and new relative highs. This reminds me of the chart of Microsoft when the market was really getting choppy back in 2020. Microsoft was just kind of doing well. And if you didn't know that the market was having so much trouble, the chart of Microsoft probably wouldn't have told you that. That's what you're seeing from some of these materials names like Alcoa. As I was screening for stocks making new swing highs earlier today, 3-month highs is what I usually screen for. A lot of material stocks on there. There's mining names and aluminum stocks like Alcoa making new price and relative highs. I would assume that a trend like that persists until proven otherwise. The chart will tell you when the uptrend is over. I'm not getting that signal just yet. Finally, as we've mentioned a number of times on the show, I'm not struggling to find stocks breaking down. I'm also not struggling to find stocks breaking out to the upside. And I'm noticing a lot of the travel names certainly bubble up to the top of the list, and hotels in particular with earnings this week starting to improve. Marriott, if you look at this chart, it's a really interesting one. There's sort of an accumulation phase or a buyer's phase where the price is trending higher. It really was more of a sideways consolidation phase for much of 2021. This is why the relative strength is so flat to down, because the S&P and the NASDAQ were actually trending higher through that period. You see this failed breakout here in November where it attempted to get above previous highs but failed, came back to the 200-day. You've now established a new level of resistance around 165, 170, we'll call it, now breaking out to the upside. What's great about a chart like this is it has a clear stop kind of naturally built in. 170 was the breakout level and the retest. You hold that, and this is a chart in an uptrend able to hold support on any pullbacks. Folks, that is our show for today. I want a special thank you to Sean McLaughlin from All Star Charts, joining us from Colorado. Always does a great job of laying out his perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.